Okay, good evening, everybody. Thanks for joining this webinar and a very interesting topic that how do you multiply wealth by investing in natural compounders. So we'll understand this from our distinguished panel of speakers today. We have two very experienced speakers from the Piper Serica investment team, Mr. Abhay Agarwal and Mr. Ajay Modi. Now, before I introduce the speakers, the main idea of this webinar is to understand the Piper Serica philosophy and to understand this new way of investing, which is small case. Because a lot of people who would like to invest in direct stocks do not have 50 lakhs, which is the minimum in a PMS. So we found that the Piper Serica philosophy gels well with the low risk, high return kind of construct where we can create wealth through natural compounders. To understand more, we have the Mr. Abhay Agarwal, the MD and CIO at Piper Serica. He is the founder and fund manager at Piper Serica Advisors Private Limited. Abhay started his investment career with Citibank in 1993 by managing its investment program. In 98, he joined Chase Capital and worked in Hong Kong and Singapore as part of a team that invested in companies in Asia. He has an experience of more than 25 years in investment management. Welcome, Abhay, for the webinar. Second, we have Mr. Ajay Modi, who is the Vice President at Piper Serica. He's an electronics and telecom engineer from University of Pune. He holds a certificate in investment research and analysis from CISI Institute, London, and is also a CFA level 3 candidate. He has been with Piper Serica for nearly 6 years now. Prior to this, he was working for Thomson Reuters, where he created detailed financial models for the world's largest AMCs, Aberdeen AMC, Nomura, to name a few. At Piper Serica, he looks after the primary and secondary research and portfolio management and compliance as well. With that, I give it that to Abhay. Just to give you agenda for this webinar, we'll have a 40-minute presentation by Abhay and Ajay. Then we'll get into how we can invest through small case. And then we can have a Q&A session. And you can put all your questions in the Q&A box. If you see the Q&A box in the Zoom thing, you can add there. Would request not to put any question in the chat because that nobody will be able to answer that time during the webinar. Over to you, Abhay.
Yeah, hello, good evening, everyone. I hope I'm audible. Abhishek, can you hear me? Yes. Okay, great.
Yeah, I can hear you.
Okay, thank you everyone for taking time off this Friday evening. And it's always nice to connect with and talk to interested investors. And I'm very thankful for Abhishek and Subhash and the team at Moat to give us an opportunity to talk to their investors. What we have done in today's presentation, we don't want to keep it too long. We would like to focus on the key points and then leave the detailed Q&A in the detailed questions in the Q&A, and we will try to cover it. So I will get started with what is Piper Serica and what is our investment process and what kind of returns and performance has it given us. So Piper Serica is a SEBI registered PMS. We manage funds across 3 platforms. In addition to our PMS in India, we also manage Piper Serica India Numero Uno Fund, which is a Mauritius-based FPI. That vehicle is for NRIs and non-Indians. And then, as Abhishek said, we have our presence on smallcase.com through model portfolios that we host 3 different model portfolios that we started exactly 1 year back in September 2020. This is our returns since last 6.5 years. We started, we were licensed to manage money by SEBI in February 2015. So we are just about 6.5 years of track record there. And I wanted to put this right up front so that investors can see the kind of returns that we have generated. In the second column, you can see since inception, our IRR is 24.8%, which is post-tax and post-fees. Compare that to Nifty, which is about 10.7%. And then we have given our returns for last 5 year, 3 year, 2 year, 1 year. And as you can see, the returns have been very consistent in not only being good absolute returns, but also beating the passive benchmark, which is Nifty 50 and also mutual funds. I think what is happening these days is that a lot of investors are looking at the stock market levels and asking us, look, We understand long-term value creation by investing in equity stocks and building a good portfolio. But looking at the Nifty levels, all-time high, every day is going up, there's no correction for a long time. Is this a good time to get in? And that is the point I wanted to cover here right up front, rather than leaving it for the Q&A. This is what our view is. And frankly, I have been investing for 28 years now. And I can tell you with a lot of confidence, I've seen value creation not only in India, across the world. And and where we are in India, I think it's a once in a generation opportunity for long term investors. I'm not addressing short term traders, I'm not addressing people who buy today, sell tomorrow. I'm only addressing investors who are looking to build a very good portfolio for a long period of time, and really become wealthy by letting the portfolio companies compound the wealth for them. If you look at where we are, the last column, India's GDP and market cap is almost equal, let's say around $3 trillion. The global market cap, if I put all the markets put together, is $120 trillion right now. So where we are is just, we have a 2.5% share of the global market cap. And we have so many countries that are way ahead of us, especially China at 20 trillion, US at 50 trillion. So we are a drop in the global ocean. We may think that, look, India stock Nifty has done so well, 17,000 levels. Will it fall now? Will it correct? Deep correction. But once you see this slide, you will understand that even when we have done well, we are nowhere near the bigger countries. We are at 2.5% share of the global market cap with 16% of world's population. So instead of getting worried about the market levels, one needs to take a step back and see, look, what value can be created over next 10, 15 years by the Indian stock market for its investors. We do a lot of benchmarking with international markets, and I used to live in Hong Kong and travel to China in early 2000s, from 1999 to 2004, and invest in Chinese companies while working for JP Morgan. And I can tell you, I see a lot of similarity between China was in early 2000 and where India is right now, in terms of demographics. A very young population, absolutely no interest in what the government is doing, but very happy to create value on its own. A very large, a generation of new entrepreneurs that came in. And despite being a communist country, you look at the growth curve that China got into. And India's market cap is same as what China's market cap in 2006. Now, a lot of people will say, look, India, China, big difference. And that is true, but at the end of the day, I believe that demographics is what drives consumption, and consumption is what drives growth for the corporate sector. So, and these things are coming together for India. So we should not resist it. We need to believe. The three trends that we see that will drive Indian GDP for next 15 years. One is rapid digitization. Second is formalization of the economy. And third is the demographic dividend. I mean, digitization, I don't even need to tell you the figures. You guys know it as well. They're all over the press, all over media. Almost everyone in the country is getting onto mobile internet. The number of internet users is growing very dramatically. People are using digital channels to consume, to sell. That is where the real growth is. You look at the UPI transactions, all-time high, FASTag transactions, all-time high, GST collections, almost all-time high. So put all this together, and what you see is a large part of India's economy that was a parallel economy, cash economy, that is being forced to move into the real economy now. It is very difficult to do business, and that itself will drive our GDP as a large part of parallel economy becomes formal. And this is the most interesting slide. If you see India's bar, which is the second one, you will see that the generation Alpha, Generation Z, and millennials, which is all three put together, are people who are less than 41 years of age. India has the highest proportion. 70% of our population is now less than 41 years of age. Our median age at 28 is the lowest in the world. Even China is aging very fast now. If you see China compared to India, 70%, only 50% of China's population is below 41. But if you look 15 years back, China's graph bar would have looked very similar to India's bar. And then you compare it to some of the aging economies like Japan, where the number of earners is now significantly lower than the number of dependents. So, what we have in our favor is that we don't have a very large old population that is dependent on the earners. In fact, we have a very large population that just wants to earn more, have a better standard of living, and is not worried, is not insecure. So I think that is our greatest asset, and all that the government needs to do is to support this aspiration of the young population, and then this is what will drive our GDP growth for next 15 years. We also did some benchmarking, and some of you may have seen this data also. What happens is some kind of a magical transition in market caps when the economies go from 2 trillion to $5 trillion. And we have seen this happen in 4 markets. In China, it took 5 years for the economy GDP to go from 2 trillion to 5 trillion. And in that time, the index gained 4 times. In USA, when that happened, the index went up by 15 times. In Japan, it went up by 19 times. So we are at 3 trillion and going to 5 trillion, which is expected in 26, 27. So do not be surprised if you see the stock market significantly outperform in terms of returns this economic growth. As a rule of thumb, you can assume that the broad market will give you twice the return of the GDP growth. So if the GDP growth is going to be 8 to 10%, then you can easily assume a 16 to 20% return by the general Nifty index. Lastly, I would just like to say that what is also happening in India's favor is that its share, its weight in MSCI index, emerging market index, is growing consistently. From 9% now, we are expecting it to go to 20% in next couple of years, and that itself will drive a lot of passive fund flows into the country. So that was about the general markets and what our view on a long-term basis is. I would like to come to our portfolio characteristics and share with you what do we have in our portfolio and how do we manage our own portfolio. So we have 16 stocks in our portfolio. 90% of our portfolio consists of multi-baggers. These are companies that have grown more than 100% since we bought into them. These names will be very familiar to you. So I'm not going to get into details. But now what I would like to do is to hand over to my colleague Ajay Modi. Ajay is our, looks after our research. And what I would like him to do is to cover for the audience our experience with 4 companies since we have held them, and how they have all gone from being a small cap to a mid cap to a large cap. And we have held these stocks in our portfolio with a lot of confidence, and we will continue to do so. So over to you, Ajay, if you can just run us through the 4 slides.
Yeah, sure, Abhay. Thank you. So this is one of the first and the top 5 holdings, one of the top 5 holdings of our portfolio. What you see here is a journey of this company, Apollo Hospital, the largest health tech platform now, or once the largest hospital company in the country. When we invested back in 2016, this was a small cap. Back then, it was the leader in beds and number of hospitals. From small cap, it went to become a mid cap around mid of 2018. And by then, hospital business had stabilized. The company was building clinics and pharmacies. As we speak today, it's already a large cap. So to reiterate, we've seen the journey of Apollo Hospital go from small cap to large cap. I have seen the journey of management talk about hospital utilization, debt repayment, to expanding the pharmacy franchise, to today talking like a real tech company. So that has been the journey for Apollo Hospital. We think that it is clearly headed to Nifty now. This is another company, InfoEdge. Again, similar journey. We bought about 4 years back. It was just about coming out of being a small cap. So from 2017 to 2019, it went from being a small cap to mid cap. and a year later from that, it went to becoming a large cap. Talks are that it is going to be a part of Nifty very soon. What changed for the company is that Naukri, which was a platform, which was a cash cow, was doing very well. The company reinvested that capital to build platforms like Jeevan Sathi and 99 Acres, which are now breaking even and starting to show money. At the same time, the company gave seed capital or literally created platforms like Zomato and Policy Bazaar. So if you go back to Zomato's web page 10 years back or Policy Bazaar's web page 10 years back, you would see that their web page had a sign saying Naukri.com venture. So Naukri or InfoEdge as a company literally seeded a lot of these multi-billion-dollar franchise, and now it is getting fruits of these. Now, very recently, the company has actually formalized investing in startups. So we think that InfoEdge now will become or come closer to being the SoftBank of India. APL Apollo Tubes again has seen a journey going from small cap to mid cap, from being a commodity pipe player to introducing technology in manufacturing hollow steel tubes, to saying creating coated products, creating specialized steel tube products. We have seen this journey again go from a small cap to literally almost getting into a large cap zone now. Dixon Technologies is a recent one. The company happens to be the largest. The company happens to be the largest outsourced electronic manufacturer. The company has gone from 2,000 crore revenue 2 years back to about 7,000 crore revenue now, and already has an order book which is about $3 billion or about 22,000 crores. Again, we see this as the next .com or next outsourced IT ecosystem being created. The company has already gone from being a small cap to mid cap, expected to become a large cap over the next 1.5 years. We see Dixon as a very, very contending candidate to get to Nifty also somewhere in this decade. While I talk to you about the journey of or case study of 4 of our portfolio companies, I will hand over to Abhay again to talk about the investment process and what goes behind investing in companies like these and staying invested in them. Over to you, Abhay.
Thank you, Ajay, for covering that. So in interest of time, I will not delve too much into our investment process. What I would attempt to do here is give you a flavor and overview, and then if and when we have one-on-one meetings, we'll be happy to spend more time on what exactly, how detailed, in detail cover our investment process. So what is our investment process? What has led to this success of, generating these high returns consistently, of finding these multi-baggers? The most important thing here that we would like to tell you is that for us, process is everything. We have a very well-defined investment process that takes care of a lot of human biases that would creep in otherwise in investment firms. So the idea here is that with our investment process, we are as objective as possible. We have set rules for both adding stocks to the portfolio, for managing the risk in the portfolio, and that the team follows to the T without any deviation. We are top-down investors, so we are not bottom-up stock pickers. So what we do is we start by identifying high growth industries in the country first. So what we do is we do a lot of international benchmarking. We look at countries that have gone through the same demographic change that India is going through now, and then we look at which are the industries that benefited, which are the white spaces that got created, and at the end of it, we should be able to say with a lot of confidence that, look, this industry is going to grow in India for next 15 to 20 years. After that, we look at the industry leader, because as part of our strategy, we invest only in the number one company in an industry. So we do not invest in number 2, 3, 4. And even an industry leader, we add to our portfolio only after we have assessed their long-term competitive edge. And for doing that, we have converted an academic model that is Michael Porter's 5 forces competitive edge model into a decision making tool. I'll cover some of that briefly later. The fourth process is that third part of the process is we look at valuation, because while valuation is not the starting point for us, we do want to be, we are very sensitive to valuations. So what we do is we establish valuation ranges, fair value ranges, and we track them actively. And the fourth part of our process is where we manage the portfolio in an active way, not dynamic way. We are not selling and buying and selling stocks. At the core, we are long-term investors, but at the same time, we try to reduce the risk in the portfolio as much as we can. These are some of the high growth industries that we have identified and that we are invested in. You can see each one of them has a unique characteristic that they are benefiting from increased spending by millennials, by the younger population that is getting richer and has the ability to spend. So healthcare, insurance, consumer electronics, consumer internet is something that is of lot of interest to us. We have recently post listing added Zomato to our portfolio. We have a very long term bullish view on that. F&B, financial services. I mean, you can go down this list. This is not all the industries that we track, but this is, will give you an idea of the interest that we have. When we say industry leadership, we look at investing in a company only when it checks all these boxes. It should have the largest market share, best national level brand. We don't invest in companies that are only regional companies. We want to see a strong distribution network that is pan India, above average margins, price leadership, product innovation, strong balance sheet. Now I will again hand it back to Ajay to talk about how we use Michael Porter's 5 forces model to assess long-term competitiveness, because this is really the core of our investment process, the core of our investment philosophy, that companies that are very competitive for a very long period of time generate extraordinary returns for their shareholders. So how exactly do we assess it? Ajay, it will be great if you can run us through that.
Sure, Abhay. So Michael Porter, or Dr. Professor Michael Porter, is a professor at Harvard University. Porter model was developed by him and has been a part of curriculum for most MBA schools and a lot of other curriculums as well. In fact, this is a model which is very widely used across consulting assignments or consulting organizations like a BCG and McKinsey. What we have done is we have kind of tweaked this model to put it into perspective of how to identify or how to use this to assess competitiveness of Indian companies. Let me quickly show you. So this is what a typical Michael Porter 5 forces looks like. While there are only 5 key parameters here, these 5 parameters become very, very critical in analyzing a business. So threat of substitute, threat of new entrants, power of supplier, power of buyer, industry rivalryness. These are broad 5 points. For us, what we've done is we have subdivided each of these 5 points into 7 sub points. So there are 35 parameters across each of these. Now, how do we rate a company on each of these 35 parameters? The rating happens on a scale of 0 to 10, 10 being the highest. For us to be able to rate this, I and my team have to do a lot of ground research. Now, what starts, or how do we start, is we go through the annual reports, skim through the data that is available in the public domain for a lot of these companies, talk to the management. But this is really just about 20% of the research. What really goes behind is the rest 80%, where we kind of go down to the street. We talk to pretty much most large distributors of these companies, stockists of these companies, lenders and bankers of these companies, ex-employees, current employees, competitors. So all of this conversation at the end of the day leads us to some qualitative and quantitative analysis. I will show you an example so this is an example of a real Porter model of one of our portfolio companies, APL Apollo Tubes. This company scores almost 9 out of 10 currently. Let me tell you, when we started 4 years back, this company used to score about little over 7.5. From 7.5 to 9, or on 35 parameters. Okay, so coming back to these 35 parameters, what happens is, on a scale of 0 to 10, we rate, and only if a company is scoring on an average more than 7 out of 10, the company becomes investable. So APL Apollo 4 years back used to score 7.5. From 7.5 to 9, what we have seen is overall industry competitiveness has gone beyond 9. Overall threat of substitute has also gone beyond 8. Bargaining power of the buyer has improved. So if you look at this model, what this helps us do, apart from deciding or analyzing and coming to a conclusion of where to invest, whether to invest in this company, this also helps us have a very, very direct conversation with the stakeholders involved in this company. So right now, when we look at it, we are still talking to the company that, look, you are the largest buyer of HR coils in the country. Why are you not still able to command some pricing power over your supplier? So this is a journey. This model, what it has helped us do is, it has helped remove any human bias and only retain what is real information, to be able to understand whether this company has a moat in what it is doing, whether it can naturally year on year continue to compound its earnings, continue to improve its balance sheet, because that to anyone is going to be the value creation. These are some of the portfolio companies. The common trait across all of them is they are number one by market cap, the number one by market share in their industry. Also, these are some of the most unique companies that we have seen. All these companies rate very, very high on our Porter model, and a commonality between most of them is that every quarter their Porter model score only improves. Our approach to valuation, again, valuation is probably the last 20% part of our investment. That does not mean we buy any company at any valuation. For us, when we look at a company, when we have scored the company on a scale of 0 to 10 on the Porter model, and if the company again scores above 7, we come to valuation. Now, when we come to valuation, what we do is we decide price bands for every company that we are investing. So there is a lower price band, there is an upper price band. As long as the stock remains in that price band, it stays at the standard allocation that it has. If the stock falls to the lower end of the price band, we tend to increase the allocation a little bit. If the stock goes beyond its current price band, we tend to reduce the allocation a little bit. So that is our approach to valuation. Having said that, we are growth investors, and all these high growth companies are priced at a premium in most cases. We are not shying away from paying that premium. Sources of our information, or what goes behind the Porter model, is checking with the suppliers, vendors, distributors, customers, management, because a management, when we speak, is always bullish on their own business. Our ground research, what it helps us do is connect with what the management is saying, whether what they are saying is real, is not real, is there a problem brewing in the business, is the business growing. Secondary sources of information, everyone might be aware of this: annual reports, management calls, analyst meetings, and analyst reports that are available. I will hand over to Abhay. Abhay will take you through the last part, which is portfolio management. How do we eventually, after doing all this hard work, construct the portfolio, and how do we actively manage it, manage the risks of the portfolio? Over to you, Abhay.
Yeah, thanks, Ajay. So I think I have about 8 minutes left in the 40-minute window. So I think we will be well done by then. So again, I talked about our portfolio management rules, and some of the things I would like to share with you is that we call ourselves active managers. So to make sure that we are acting as active managers. We make sure that not more than 25% of our portfolio, even though we are a multi-cap fund, not more than 25% of our portfolio is made up of Nifty stocks. So the balance 75% are non-Nifty stocks, because that is the only way we can significantly beat Nifty, by making sure that we have non-Nifty stocks in the portfolio that are doing well. Second rule is that we allocate our stocks equally across mid cap, small cap, and large cap. So our ideal allocation is one third, one third, one third, which makes sure that there are the portfolio on a risk return basis is adequately diversified. When we buy any company, though we are very long term investors, we do a lot of research, because we want to make sure that we should not be forced to sell any stock within 2 years. So at least we should have a visibility of the earnings and performance. Of course, if something, a force majeure event happens, some knowledge, some information that comes into knowledge that nobody had earlier, then we would exit. But barring that, we do a lot of research to make sure that we're covering every point, that we are holding something for at least 2 years. We have a model portfolio construct. So we have 16 stocks in the portfolio, and we have the model weights for each one of them. We rebalance this once a quarter. So we are not buying and selling stocks on a daily basis, but we rebalance only once a quarter. And we do not like to diversify the portfolio too much. So we have done a lot of empirical studies which show that in Indian context, 15 to 16 stocks is the right level of diversification, where you're optimizing your risk and return. Any further diversification, instead of reducing risk, reduces return more than it reduces risk. So, and it also makes sure that we are very focused on the companies that we have in our portfolio and are tracking them actively. In terms of risk management, the three things that we look for: one is concentration risk. Now, the good thing is that in our portfolio, each company is, we don't have any duplication of sectors. So each company is a leader of its own sector. So as a result, we are fairly diversified. We do not want any one company to be more than 15% of the portfolio. If that happens, we sell partly and book profits and reduce the allocation. Liquidity risk we track on a weekly basis to make sure that if the entire portfolio needs to be liquidated at any point of time, it can be done within 1 week without any impact cost. So that makes sure that we are not getting stuck into any stocks that are very good but are actually very illiquid. And if we were to exit it, it would lead to a big price correction. Valuation risk we cover by sticking to our valuation ranges. Again, this is there is no subjectivity here. We define fair value ranges. If the stock goes beyond that, we exit partly, book profit, and bring down our allocation. I would also like to mention that there are certain exclusion stocks that we do not invest in. We do not invest in public sector enterprises. We do not invest in any company that has even a smallest degree of questionable corporate governance. We do not invest in cyclical businesses, since we invest only in companies that compound their earnings year on year and are not cyclical. And we do not invest in export-oriented companies, because we want to stay invested in companies that are benefiting from Indian consumption and Indian demand. We are registered with US CFA Institute. And as part of that, two things I would like to bring to your notice. One, we have no conflicting businesses. So we have no broking, we have no custody or distribution business. Our only source of income is management fees. And this makes sure that for our clients, we are getting best of breed partners and service providers at the lowest possible cost. Secondly, we have full skin in the game. So I and my family, we invest in public markets only through our PMS. We do not have any other investment account. We don't have any other trading account, broking account, to make sure that all our money, and all our money is invested in the same model portfolio as all other PMS investors. And I think there can be no bigger proof of commitment than somebody saying that, look, I am fully with my investors. So everybody does well, only then I do well. So we have a minimum 10 crore investment in the PMS at any point of time. Right now, it's gone up to 30 crores. We have no plans to bring it down. And we want to be in the same boat as our investors. Lastly, the team, we have a 10-member team, now 11 actually. I am the CIO and founder of Piper Serica. I did my MBA from Bajaj Institute in '93. And then I worked with Citibank and JP Morgan private equity fund in Singapore till 2004 when I started Piper Serica. Rajni Agarwal is head of research. She has done her MBA from Bajaj. Before that, she studied at Delhi School of Economics. She did her MA Economics. And in her last job, she was a fund manager with SBI Mutual Fund. Ajay Modi, you heard him talk just now on this call. He's a BTech from Pune University, and he's a CFA level 3 candidate, and has done his prior to Piper Serica. He has been with Piper Serica with 6 years now, 6.5 years now, and prior to that, he worked with Thomson Reuters research team. So we have a full team, for research, for relationship management, investor relations. Yeah, and I'm sure there will be some questions about the market levels and all. I would like to leave you with this one last slide when we finish our presentation, which is that, look, we have plotted Nifty's last 20 years. And as you can see, this looks like a very volatile chart, but it is headed one way. Now, from 800 level in September 01, we have gone 1000 level, we have gone 20 times, to 17,000 now. But this journey has not been smooth. There are periods when the market corrected sharply. There are periods when it spiked up sharply. It has gone up and down. But if an investor stayed true, and said that, look, markets will be markets, they will go up and down. All I care about is buying into a good set of companies and holding them for a long period of time. That is the only way that market levels and market movements stop mattering. The market levels matter a lot if you're a short-term investor. If you're looking to invest for 10 days, 20 days, 3 months, 6 months, 1 year, 2 years. But if you're looking at equity investing only as a way of managing your savings, and which means that you are willing to stay invested for a long period of time in the right set of companies, then only you will enjoy the power of of compounding. Then that is when you create real wealth as the portfolio companies compound their earnings. So the message here is that rather than getting lost in market levels, which was 8,000 last year in March to 17,000 now, nobody really knows what will happen to market 6 months later, 1 year later. If they knew, they would be phenomenally rich right now, but they are not. So all you can do is allocate part of your savings in consultation with your financial planner to equity, and make sure that the equity you are buying, stocks you are buying, are vetted by a professional investment manager who's fully committed to those stocks in terms of having invested their own money in them, and then holding it for as long as you can rather than looking at trading. That is, to my 28 years of experience, I have seen no other way of benefiting from equity investing than what I just told you. So with that, I will conclude my presentation, and we will open it up for Q&A.
Abhay, before opening it up for Q&A, I will hand over to Ketan.
Yeah.
Ketan will, because while we talked about the 3 platforms, the interest here is on Smallcase. So Ketan will quickly take you guys through how the Smallcase journey looks like, and how can you swiftly, within few clicks, onboard, invest in our strategy. The minimum investment on Smallcase in the strategy is 2.5 lakh rupees. Ketan, over to you.
Yeah. I would like to share my screen. Am I audible?
Yes, we can hear you. Yeah, Ketan, we can see the screen, but we can't see you.
Yeah. So as Ajay sir told us that Piper Serica has in total 3 small case strategies. So one of them is wealth compounder and starts with rupees 2.5 lakhs. Here is how one can easily subscribe through this digital platform. So here basically you can see here subscribe now button. So the investor can go and subscribe, click on subscribe now. After that, they just have to put their basic information, just as name, email address, phone number.
Ketan, to me, your screen is not moving.
Yeah. Ethan will have to share that particular window. Yeah, we can see you, Ketan.
Yeah. Is it now moving?
Yeah, it's moving.
Yes, yes.
Yeah. Yeah. So just a second, I'll quickly. Yeah. So after clicking on subscribe now, here the investor just have to put their basic details, just as name, email address, phone number. After continuing further, they can select their preferred broker. There are total 15 brokers on Smallcase platform. After selecting the broker, it will redirect them to their broker ID login to put their broker ID and password. So once that is done, they have to just fill up this risk profile they according to their convenience, and they have to also put their birth date over there. The next step will be the subscription fee will be shown there, and once they click on the subscribe button over here, then an OTP will be sent to their email address which they have associated with their broker, and then after putting the OTP, they have to create a Natch mandate. So now Natch mandate is for the fees payment. So a Natch mandate, they have, once they select on the Natch mandate, then they have to, a pop-up window will open there, and they have to select all the details they have to put in there. They can select either net banking or debit card option, and once they click on submit, their subscription will be done. So now after subscribing, they can view their portfolio and they can see the weightages of the stocks. So going ahead, they can click on invest now. They can, this window will open and they can confirm their investment amount. So it will start with rupees 2.5 lakhs. But if they wish to increase that amount, they can, they will get an option to increase that amount. So after that, once they click on invest now, the investment will be done. All the orders of buying will be executed automatically by the Smallcase platform. So they can view their investments through their laptops also, as well as through phones also. So Smallcase also has a mobile app which is working on iOS as well as on Android. So that's it. That this was how easy it is to invest in Smallcase platform. So I'll hand it over to Ajay sir.
Thank you, Ketan. I think that was a little too fast. To me, it went like a breeze. So probably you'll have to share this one with everyone for their convenience later. I am sure Abhishek will agree with my thought.
Yeah, absolutely. Thanks, Ketan. But I think with limited time, I think that's the best you could do. So thank you, Abhay and Ajay, for the presentation. I think it was very well coordinated. The mic going from you to Ajay, then back. So now, a lot of investors and the participants are people who are very happy with mutual funds. They have been there, done their SIPs, and created a decent amount of wealth. Now, can you make a case on why they should look at a Smallcase, or why should they look at a Piper Serica? If I am happy with my mutual fund, am I missing something? And can you make a case for that? Yeah.
Yeah, I think mutual funds are a good product. I think mutual funds generally have given access to retail investors to invest in stocks, in professionally managed portfolios that they did not have access to. For a retail investor, what are the options. They have limited ability to create their own portfolios, track them. So I think mutual funds have done a very wonderful job of creating the equity culture, giving an opportunity for retail investors. There are two things I would like to point out, and this is not to say that, look, don't do one and do the other. The two things coexist. So in terms of PMS, PMS is a HNI product, and mutual funds are not an HNI solution. Mutual funds are a good way for managing equity savings for retail investor. They're probably not an HNI product. So HNIs need more curated portfolios, different portfolios that appeal to their risk and reward profile. So that is where I would say that PMSs are better than mutual funds for HNI investors. On mutual funds versus small case, again, I think the difference is that mutual funds and small case portfolios fit in somewhere between a mutual fund and direct investing. So now retail investors can make their own portfolios, but at times they are not rightly allocated. They cannot manage allocations. They cannot track those companies. Uh, Whereas if you give money to mutual funds, the mutual funds have 70, 80 stocks at times, overly diversified, underperforming the Nifty. So that is where small case comes in, which is saying that, look, this model portfolio has been constructed by a professional firm that is tracking these companies, tracking allocations. So I can just apply, or I can just copy this portfolio, and then the execution also becomes very simple. And the portfolio is very transparent, unlike a mutual fund where you only know at the month end what is there in the portfolio. Here you can see your stocks on a daily basis. So I would say that this small case is a very good way for investors who want to take some of the investing decisions in their own hand rather than giving it all to mutual funds. And I think, at least I can say, for our small cases have significantly outperformed the mutual funds. So we are happy with that. We are hoping that will continue. And the small cases that we have created also give an opportunity to investors to pick and choose their risk return profile. Like one of our portfolios is only a small and mid cap portfolio. One is a multi cap. One is a ultra large cap portfolio. So it gives an opportunity to construct, in consultation with their advisor, their own allocation across these portfolios.
Yeah, thank you. So one of the questions we are getting is that you had shared some 4 stories where some small cap company has become a large cap. Now, how do you think going forward, because the companies start still there in the portfolio, they can sustain this high returns, because we've seen 24-25% CAGR for these companies?
So let's look at, so when, you look at some of the large cap companies in India right now. TCS recently became a 14 lakh crore market cap company. You look at HDFC Group as a whole, all the companies you put together is 20 lakh crore market cap companies. And these are the companies, same companies that 20 years back were not even 1 lakh crore market cap company. And they were still generating high IRRs, high CAGR. So if you're doing well, growing well, there is nothing that stops you from, increasing in your size from 10 times, 15 times, 20 times. You have to give it time. So it may happen that some of these may consolidate for 6 months, a year, but as long as the business is performing, I see no reason why the compounding will stop. So if you look at some of the stories that we put out, you look at Dixon. Dixon is still, despite the growth, is still a 20,000 crore market cap company. You look at APL Apollo, still 20 odd thousand crore market cap company. You look at Apollo Hospital, 75,000 crore market cap company. You look at Info Edge, is still about 10, $12 billion company. The largest internet company in India, Info Edge, is valued at $12 billion. You have in China three companies which add up to $1.5 trillion of market cap. I mean, we are not even scratching the surface of opportunity in a lot of these companies. You look at Titan stock price has gone up by 150 times in last 15 years. So I think in terms of wealth creation, You don't need to have too many companies in the portfolio. All you need to do is make sure that what you have is growing, and then have the confidence that they will grow. In our mind, there's no point setting a limit to what these companies can grow to.
Thank you. So one more question is, what does Piper Serica do when there's a huge crash or a dip in the market? So what were you doing in March 2020 when there was a 40% drop in that quarter?
So we look at ourselves as equity allocators, and not necessarily cash allocators. So what that means is that we do not normally take cash calls. We do not suddenly get into cash if the market corrects very rapidly, sharply. But at the same time, last year March was an extraordinary situation because we could see that lockdown coming up, and unforeseen situation not only in India but globally. So last March, for the first time, we exited a lot of portfolio companies that we thought will be negatively impacted for a very long period of time because of COVID related lockdowns, like PVR, Phoenix Mills, all very good companies, but will struggle, Indigo, VIP. And we raised our cash allocation in the portfolio to about 35%. But it's not that we want to do that. Our ideal cash holding in the portfolio is about 5%, not more than that. Because we believe that when investors have given us money, they have given us money to invest in equity, and they have consulted their financial planner for their allocation before that. So we do not really want to take further cash call on that. But if an extraordinary event happens, then we will definitely bring our experience in the market for the last 3 decades to, if required, take cash calls. But it will be more of an exception than a regular occurrence.
Now, in the mix of your stocks, lot of stocks are very high PE stocks, and you also said that you are very excited about adding Zomato, where there is no P because there is no profit. Sorry, E. So there is no E. So how do you look at that, and how do you value these kind of companies?
Yeah, I will ask Ajay to answer that. He's very passionate about that question. So let Ajay answer that.
Thank you, Abhay. So two things here. First, P, price to earnings multiple, price to book multiple, price to EV multiples, all these are very, very dumb ratios. What goes behind them is what is the cash that the company is eventually making. Now, to put it in perspective, these multiples are just a derivative of a real DCF. In the DCF, to my mind, the biggest problem that a lot of analysts have while doing a DCF is putting the right number to the terminal value. So for example, if I go back 15 years, and if I said that if I will do a 5-year or a 10-year DCF for HDFC Bank, and then put a terminal growth value of 6%, HDFC Bank at 5 times book value would have been tremendously expensive. But if I simply change that, simply say that, look, 10-year DCF, instead of 10-year DCF, I will do a 20-year DCF. And even for the balanced terminal value, I will, instead of giving it just a 5% or a 6% growth, I will try to establish a fair growth number. If these two things work well, then you know that the present value of the cash that the company is going to be generating is tremendous. For example, Zomato. Now, Zomato, let me explain very quickly, does about 1,000 crore of deliveries per month, 1,000 crore worth of deliveries. Now, 3 deliveries per user into 1 crore users into about 500 rupee of, or not even 500, 300 rupee value of delivery. So 300 rupees per delivery into 3, which is 900, into 1 crore, which is 900 odd crores per month. For the entire year, that's about a little over 11,000 crores. Now, if you just simply say that India as a country has 46 crore internet users, 8 crore transacting users. Out of these 8 crore transacting users, only 1.8 crore users are ordering food online. 5 years later, I am saying that this 1 crore, 1.8 crore or 2 crore will just go to 4 crores. So you will have 2x the number of people ordering. The average order value, which is 300, if you just compound it over 5 years with food inflation, 5 years later, that 300 number will be about 600. And if you say that the momentum will increase from 3 orders per month to 4 orders per month, you're talking about a annual delivery value of about 55,000 crores. So if a company has a capability to go from 10,000 crore delivery value to 55,000 crore delivery value, today, while it does not make profit on the company level, the company turned profitable on unit level in Q4 of last year. If it has turned profitable on unit level, the corporate overheads don't compound as much as the orders compound. So corporate overheads will continue to be between 500 and 600 crores, which means that, look, eventually on our 55,000 or 60,000 crore delivery value, the company will make about 4 to 5,000 crores of cash flows. Now, if you are able to compound that for period above next 5 years and then discount it forward, I do not see a problem why someone should not invest. So again, to put all this into one simple perspective, in a DCF, 70% of the calculation is terminal value. If you are able to estimate HDFC Bank's terminal value for the next 15 years to be 18% versus someone else saying 6%, you will say that it is undervalued, whereas someone who's estimating it at 6% will say it is tremendously overvalued.
So one observation in one of the, you have gave an example of TCS as a value creator and a wealth creator. But if you see your portfolio of wealth compounder, there is no IT company. And also in your last one of the slides, you said that we do not buy export companies. Though you buy platform, but you don't buy IT. So why is that distinction?
Yeah, so platform is different. Sorry, Ajay, I'll just take that quickly. So we are very happy to invest in companies that are using technology to grow their core business, whether it is food tech, insurance tech, health tech, anything that they're using. Whereas software services companies like TCS, Infosys, Wipro, that are just providing software services or B2B companies, the trouble is that we are not able to complete our Porter model scoring because we do not have access to their large B2B clients who are in Europe or US. So just for that reason, we are not able to add them to the portfolio. But the platform companies like, Angel Broking or CDSL or even MCX or Zomato or, so many more that we have, even Apollo Hospital, we see as a technology company now. We are happy to have them because they are, or ICICI Lombard, HDFC Life, we see them as companies that are using technology, using internet to grow their core business. So that's why the differentiation.
Okay. So last two questions. One is, when do you sell the business, and you not shared any loser? If you can share that one loser which you thought would grow big but did not and kind of fell off the cliff.
Yeah. Now again, very good question. So when we sell a stock is when, as part of our Porter model scoring system, what we do is we rate each company on a score of 1:10, as Ajay mentioned, and only when the average score is more than 7, that company is investable for us. Now, if it happens that we update this Porter model score on a quarterly basis, in a particular quarter, the score falls below 7. So then we remove it from the portfolio completely, because then we believe that the leadership is threatened. Its competitiveness is threatened and it will lose competitiveness. So that is the only reason that we remove a company completely from the portfolio. And frankly, it does not happen very often, because we have seen companies which are leaders maintain that leadership. It's like very strong leaders do not let go of their leadership position. They are highly competitive. So we have had very few instances of actually this happening. The second question on losers, I would say, rather than using the word losers, because losers is a very relative and time thing, but companies that we thought will do well with all our research, but kind of negatively surprised us because the fact didn't stack up. I mean, one example would be a VIP that we had in the portfolio. And we thought that, look, luggage space, 50% market share. Samsonite is distracted, Safari is too young. So this is a company that will grow rapidly, because in India, as air travel picks up, everybody is looking at standardized size of luggage. But so we bought it. But then as we continued our Porter model scoring, we realized that a lot of things were not stacking up in terms of what the company was telling us and what the trade channels were telling us, especially what the distributors were telling us, what the retailers were telling us. And it was a confused thing that we are hearing back. We could not connect what the management was telling us and what the trade was telling us. So for that reason, we exited that company. It was an underperformer for us. So that would be a good example of something that, again, doesn't happen very often, but of a company that we thought is in a promising business, but just could not get going.
Yeah. So that's the last question now, that you have two insurance companies in your portfolio, HDFC Life and ICICI Lombard.
Yeah.
So what makes you so bullish and so reliable for growth? One person is asking. Yeah.
So if you look at the breakup of insurance segments across the world, life insurance is very big. Life insurance is typically as high as 90% of the overall insurance premium collected on an annual basis in countries like US, even China, Europe. So we think that life insurance in India has a very long way to go, like 10, 15 years. We just scratched the surface in terms of providing life insurance to people. There is greater awareness. There is awareness that it is protection, real protection, that you need to, now employers are contributing to life ownership. And earlier, this was a market that was monopolized by LIC. And LIC is a very, very strong competitor, very strong incumbent, does not let things happen easily. But at the same time, there are legacy issues. It is highly dependent on the physical agent channel. The digital aspect is still not very robust. So we see HDFC Life with its clear leadership, and we have HDFC Life in our portfolio for last, since it listed. So we have seen its journey from whatever 250 odd rupees to wherever it is today. And the company has done very well, grown its market share. LIC on a quarter-on-quarter basis is losing market share slowly and steadily, and the private guys are picking it up. So of all the large players in life space, we see HDFC Life as the best bet. And ICICI Lombard is our play on non-life insurance, because that non-life insurance is also going to be a big play, and non-life consists of health insurance, auto insurance, fire insurance, marine insurance, all kinds of stuff. So we believe that ICICI Lombard, with its management team, with its kind of commitment to the business, digital adoption, is going to grow the non-life. So that's why both insurance, but completely different businesses.
I think with that, we can wrap this. Thank you so much, Abhay and Abhijay, for giving your time. And I thank all the participants to join on a Friday evening. I'm sure this session would have been quite enlightening, especially for me, to understand Zomato the way Ajay explained it. So if you have any questions or about Smallcase, you can get in touch with our team, either Subhash, myself, or Shruti from our team. We can help you with the process of onboarding. And Ketan is there to help us from Piper Serica. Thank you so much, Abhay and Ajay.
Thank you, guys. Thank you,
Thank
Subhash.
you all.
Thank you, everyone.
Thank you, Abhay.
Thank you.
Ajay. Thanks a lot.
Thank you, Subhash. Thank you, Abhishek. Bye-bye.
Bye.
Bye-bye.